What a wild ride it has been over the last week in the markets. We're talking all of that today. Some ominous news from the Cromford Report as it relates to foreclosures, as well as what the heck happened last week with mortgage rates and where do we stand today after Liberation Day and all of the stuff going on last week in the market. So let's get into it. We are talking about foreclosures. So it's been a few weeks since I brought up foreclosures, but the Cromford Report has these creeping back up right now. So we're going to talk about it. Foreclosures are rising. They're saying although we remain well below the normal, which is the same thing that they said a few weeks ago, the chart is showing the number of pending foreclosures in Maricopa County measured weekly and comparing 2025 with 2024 and 2020. And we are seeing some increases. So 2025 is the pink line. Like I said, a few weeks back, I was sharing this. We were seeing modest increases and they were just saying, it's something to keep an eye on. But now they're saying something a little bit more serious. They're saying we need to keep an eye on this. They say that the trend is concerning, actually. And if the count continues to rise at this pace for several months, it would start to get more ominous. So although foreclosures pending is much below where we have been in the past, and this is 2020. So obviously before COVID hit, we were higher than this. And then everything went down and we just really haven't seen a huge increase in foreclosures since 2020 because of the changes that lenders put in place. And also the housing market was just really hot. So no one really needed to foreclose. But this has been kind of creeping up over time. And now we're in a place where we're starting to see a pretty consistent increase with foreclosures pending. And we also have to keep in mind that the unemployment rate continues to go up. So that's something to watch because as that continues to go up and as we're seeing more foreclosures pending, that could be something that is going to take off more than maybe we expected. This number that we have today is 1,400. This is up over 50% from last year. Again, Cromford Report saying that's not necessarily a problem in itself. It's just the trend that we want to watch moving forward. So let's talk about what else is going on. Builders sitting on a pile of unsold homes. They're slashing prices and offering mortgage rate deals. This is from Yahoo Finance. They're saying that as of February, builders had completed some 119,000 homes that weren't yet sold. To lure buyers, they're dangling incentives like mortgage rate buy downs, closing cost credits, money towards upgrades. In some cases, they're slashing prices altogether, something they usually try to avoid because it hurts the earlier buyers. So this is what's going on right now with new construction in many places. I will say I've seen some of that going on in Phoenix as well. They are definitely offering incentives, rate buy downs, that kind of thing. And I've even seen some cases where the prices of the newer homes are lower than some of the prices of the homes they've previously sold. So if you are thinking about new construction, just know that you may have a pretty big advantage in terms of incentives, possibly even lower home prices than what you were seeing as recently as 3 months ago. Now, home builders have also been in the news because of all of this talk about tariffs. Obviously, that could make things a little bit more expensive for builders to be able to build. So there's been a lot of talk about how that's going to affect the real estate market and new construction in particular. I wanted to share this article from Redfin, and I will say, first of all, this came out April 4th. A lot has changed even since April 4th. Okay, so Redfin saying tariffs push mortgage rates down, upping home buyers' purchasing power while amping economic uncertainty. So as excited as I would be to share these stats that a home buyer on a $3,000 monthly budget can afford $458,000 home, as of April 4th, things have changed since then because what happened last week is there was so much uncertainty in the markets that the mortgage rates ended up going down quite significantly to the lowest numbers that we've seen this year so far, mid sixes. And that was exciting as we ended Friday. However, Monday came around and everything changed. The worst 24 hours for rates so far this year. Tariff volatility volatility giveth and taketh from interest rates, according to Mortgage News Daily. They're saying up until Friday afternoon, it was mostly giveth-ing. In other words, the prospect of trade wars between the U.S. and numerous foreign countries has generally caused weakness in the stock market and strength in the bond market. That makes mortgage rates lower. So the pattern started breaking down on Friday. The weakness kicked into overdrive today, meaning Monday of this week. There was certainly some volatility surrounding news headlines that were less than credible. Bonds maintained steady selling pressure all day. As a result, mortgage lenders were under progressive pressure to bump today's mortgage rates higher several times. The net effect is that we've moved from 2025's lowest rates to the highest now since February in the space of 24 hours. So the mortgage rate that you were quoted on Friday is no longer something that is available come this time in the week because of all of the changes. Monday kind of did a 180, essentially. And so this is another article from Mortgage News Daily talking a little bit about what happened on Monday. Like they said, we had the lowest mortgage rates that we've seen all year, and then everything changed within 24 hours. So as of today, and you can see this on the graph here, we're 6.85%. On Friday, we were around 6.6%. So now here we are, 6.85. It's even higher than what we've seen in recent weeks. You're going all the way back to about February 20th when we see rates in the same neighborhood as where we're at today. So now Mortgage News Daily is saying Liberation Day volatility has come and gone. Basically saying a lot of that excitement is most likely over. Where we are at right now with mortgage rates is probably where we're going to stay for a little bit, just kind of moving sideways. They say, long story short, there is still plenty of fear and uncertainty about how things will shake out, but the past 2 days have shown bond traders that the administration is not simply going to tariff the global economy into oblivion, a concept that had contributed to 10-year yields breaking below 4% last week. So you have to remember that uncertainty in the stock market typically means mortgage rates go down. Mortgage rates tend to follow the yield on the 10-year treasury. So when that is affected, then we will see that coming out in mortgage rates. So last week was just a bit of a wild ride, quite a roller coaster of news, and not only for the stock market and the economy, but also for housing as well. Trump tariffs showdown could have a huge impact on the housing market, according to this article. They're saying that prospective homebuyers are waiting for the market to turn around and are concerned that tariffs could create a housing slowdown and reduce affordability. The housing sector comprises over 15% of the U.S. GDP and will be heavily impacted by tariffs on building materials such as lumber and steel. And 70% of imported lumber comes from Canada, which is already subject to a 14.5% tariff rate. The National Association of Home Builders president, Jim Tobin, believes that these tariffs will counteract progress being made in the sluggish housing market. The organization noted that tariffs are not only expected to raise the cost of building materials, which are up 34% since December of 2020, far higher than the rate of inflation, but also wreak havoc on building materials supply chain. In turn, this will put even more upward pressure on prices of building materials. They estimate that the tariffs could increase new home prices by an average of $9,200. Other projections anticipate price hikes of up to $25,000. So remember when I said new construction is slashing prices? Now might be a good time to take advantage of that if all of this goes through. And if that information is correct, new construction could be a little bit more expensive in the future. Now, amidst all of the economic news last week, we also had the jobs report come out, which I think is worth noting. The U.S. economy added a robust 228,000 jobs in March, which beat the forecast of 140,000. We also saw the unemployment rate tick up to 4.2% in March from 4.1% in February. So remember, thinking about those foreclosures as we see unemployment increase, although that's very slight. If we continue to see that being a trend, we also see foreclosures increasing, then we know know these foreclosures may be something that we really want to pay attention to. Speaking of which, if you'd like to check out a list of homes in pre-foreclosure, check the description below. I have a link where you can get that information. Now let's take a look at what's going on in the Phoenix metro market. Particularly, we're going to look at active listings as we've been tracking those every single week. Before I jump into that, if this is helpful for you, please consider subscribing. I just hit 10,000 subscribers and I am so excited about that. Thank you all for being loyal subscribers over this time period. I really appreciate you. And share this with someone who might find it helpful. Active listings. So where we're at today, 25,000 active listings on the market in the Phoenix metro area. Obviously, looking back at last year, we were at 17,306. This line continues to increase week over week. Not really seeing, it's not crazy, but we're not seeing much of a taper off in active listings. And we've talked about this week over week. Demand really isn't keeping up with the number of new listings hitting the market. Speaking of which, we were looking at new listings by month throughout the year so far. And every month this year has beat the number of new listings hitting the market compared to the past couple years. So the red line is 2025. So in January, we had more new listings. February, more new listings in the last few years, as well as March, we finally got that information. So 10,396 new listings came to market in March, beating 2024, where we had 9,140, beating 2023, where we had 7,910. And then we have the year 2022, where we had 10,430. So we actually had more in 2022 than we actually did this year. However, very, very close. And if you look at what I find interesting, every month before this month, we have had more than 2022. Now, keeping in mind what was happening in March of 2022, everyone was trying to jump on the bandwagon and sell, and little did they know that interest rates were about to skyrocket and all of the music was about to stop. So I'll be interested to see what happens in April. So far, we've added 21 new listings to the market in the last 8-9 days. So we'll keep an eye on how new listings progress for April. Now, like I said, our demand isn't really keeping up with our supply. So if we look at listings under contract, this is basically our demand out there. It's following the same pattern as we saw in 2024, which is great, but you have to remember that we are seeing more listings on the market than we had in 2024. 2024, we had 17,000, if I'm not mistaken, what we had just looked at. And now we have 25,000, yet our listings under contract, our buyer demand, isn't going any higher than that. I just added 2023 on the screen so we could see the difference here. Had fewer listings in 2023, but we had a higher number of weekly listings going under contract. So that just helps you understand that, things were moving a little bit more then. We had higher buyer demand and we had fewer listings on the market. Now, what you'll notice when we look at the CMI for this week is we actually had an increase in demand. We got out of the 70s. We're at 81 for demand. So that's 19% below normal. So demand has actually increased a little bit. Perhaps because mortgage rates had been trending downward. I don't think that this is reflecting last week's activity just yet, but we had seen some movement in rates, so maybe that's where this is coming from. Supply, however, also increased, so we're above normal. We're at 102.2 for supply. Overall market index is at 79.3. According to the CMI, the Cromford Market Index, anything under 90 is considered a buyer's market. So the Phoenix metro area is technically in a buyer's market. Now, if we look at every major city, you can see where we stand this week. Seeing a decrease across the board for most of these when we look month over month. So the average change month over month was negative 3%. Last week, the average change month over month, negative 2.7%. So again, seeing some acceleration. This is a trend that we saw starting 2 weeks ago. Still just a slight difference, but we are seeing overall, this moving closer to a buyer's market rather than a seller's market. Cromford Report is also saying, unfortunately, consumer sentiment has weakened to the point that some buyers may be tempted to put off all major purchases. Foreclosures remain well below normal, but unemployment is ticking higher. We need to keep a wary eye on the number of notices of trustee sales. We talked about that. These have not been a significant source of supply for many years, but the trend is moving in a negative direction. So again, emphasizing those foreclosures that we're seeing, emphasizing that upward trend, and something that we want to keep an eye on in conjunction with the unemployment rate. Now, if we look at the contract ratio, they really haven't had their map here working very well to show all the zip codes. So I'm actually just going to jump over to the overall contract ratio and we can see where that stands. That's at 36 throughout the valley, and 36 on the contract ratio is a warm market. Again, they don't have this in the key right now, but between 30 to 60 is considered warm. So overall throughout the valley, we're kind of in that warm zone. We have increased on the contract ratio because, back in February, we were, or even, in January, just as we were getting started, we were kind of breaking into the 30s. So we've remained there. And just as a reminder, the contract ratio is showing the number of homes available for sale versus how many of those are actually under contract. So basically, it's just showing a little bit more real time of what that supply and demand of housing looks like throughout the valley. So what this means if you're a seller, well, the market is a little bit more price sensitive. Remember, overall, we're in a buyer's market. So if you're listing your home for sale, you want to make sure that you're listing at a fairly competitive price if you want to get some traction on that property. If you're curious what you might be able to sell your home for, I have a link for an instant home valuation. Check the description below to click that. And if you are a buyer or a seller, not entirely sure what you should do, what your next move should be, feel free to schedule a discovery call with our team. We've spoken with a number of folks lately who are considering making a move one way or the other, just want to better understand what their options are based on the market conditions. So check the description below to schedule that. And for that list of foreclosure homes, I have that below as well. Thanks so much for joining me, you guys. Thanks so much for 10K, and I will see you guys next week on my next market update.